$3.7 billion for a Japanese glass company. Apollo is officially bored of software and into windshields.
Oh, please. They are betting on solar panels, not just sedans. Read the actual filing.
Hey, February hit $550 billion in deal value. People are buying everything. I even heard Blackstone is looking at a global cricket league.
Wait, really? A cricket league? I need to see the math on that. But first, explain how Apollo plans to flip a century-old glass maker. The rundown?
$550 billion. That is the February global M&A total, second highest month in 4 years. So anyone telling you the market is still frozen is just looking at the wrong sectors.
Or they are looking at the new risk factors. Tariffs are the new inflation, Nate. Everyone is terrified of global trade volatility right now, which perfectly explains why Hapag-Lloyd just dropped $4.2 billion to acquire Zim outright.
Taking them right off the New York Stock Exchange. I actually love that deal. It is pure scale. You consolidate shipping routes, you build a fortress, and you survive whatever tariff wars are coming.
Sure, if the regulators actually let you build the fortress. Speaking of which, Cintas is buying UniFirst, $5.5 billion to create what looks an awful lot like a uniform rental monopoly.
Oh, come on. It is not a monopoly. The fragmented mom-and-pop market is huge. This is just smart consolidation. The cost savings in truck route optimization alone easily justify that price tag.
Route optimization? Nate, you are literally quoting a pitch deck right now. The FTC is going to look at this and see one giant corporate overlord controlling the work shirts of every mechanic and delivery driver in North America. They will absolutely fight this.
I will take that bet. But while the FTC is busy looking at dirty laundry, Blackstone is out here looking at cricket.
Wait, what? Like the sport?
Yes, Blackstone is reportedly kicking the tires on a massive stake in a new global cricket league.
Private equity buying into a cricket league. I guess when tech multiples get too high, you just pivot straight to wickets.
It is a massive, untapped media market. Do not laugh. Though if you want traditional healthcare plays, Olympus Partners is selling EyeSouth's retina business to Cencora for $1.1 billion.
Now that is a classic bolt-on, and Gilead is quietly nearing a $2 billion deal for Oro Medicines.
Right, plus Estee Lauder finally confirmed they are talking merger with Puig. The beauty market is heating up fast.
I want to see the multiples on that Puig deal, but honestly none of these are the most interesting structure of the week. Apollo just pulled off a $3.7 billion buyout in Japan.
Nippon Sheet Glass, Apollo's biggest Japanese private equity venture ever. I have some very strong thoughts on how they are valuing the renewables side of that business. The big one. $3.7 billion for a glass company. I mean, Apollo is literally buying windows.
Not just windows, Nate. Nippon Sheet Glass. This is Apollo's biggest private equity play in Japan ever. They are taking it completely private, and it is a massive bet.
The Japan angle is what fascinates me here. Every mega fund is hunting in Tokyo right now. The yen is weak, corporate governance is finally shaking up, and you have these massive legacy industrials just sitting there waiting for a sponsor to optimize them.
Optimize. That is such a polite banker word for what Apollo is actually going to do.
Hey, I am reformed. But you have to admit the thesis is solid. Apollo says they are going to push aggressively into automotive glass and renewable energy. Solar panels need glass, Maya.
Right. And that is exactly where I get skeptical. I read the release. They are leaning so heavily on the renewable energy narrative. But if you look at Nippon's actual historical revenue breakdown, it is basically a car parts company. They make windshields.
Windshields for electric vehicles, boom, green energy play.
Oh, come on. Slapping a solar panel narrative on a 100-year-old industrial manufacturer does not make it a climate tech stock. Apollo is buying this for the predictable cash flow. They're going to squeeze the margins, cut the legacy fat, and maybe bolt on a smaller auto supplier. The green energy stuff is just window dressing.
Window dressing for a glass company. Please tell me you did that on purpose.
I refuse to acknowledge it.
Look, I am pushing back on this. I actually disagree with you on the growth strategy. Solar is incredibly glass intensive, And with global trade tariffs becoming the top risk for deal makers right now, having a localized captive supply chain for solar components in Asia is huge. You know the data. Tariffs and regulatory changes just officially bumped inflation as the number one bogeyman in the boardroom.
I will give you the tariff point. Sourcing raw materials is an absolute nightmare right now, but $3.7 billion is a heavy check just to secure supply lines. Apollo needs a phenomenal exit in 5 to 7 years to make the math work on a buyout this size.
Which is exactly why taking it private is the only viable path. You cannot do the ugly restructuring work Nippon needs while retail investors and analysts are breathing down your neck every 90 days.
Fair. And honestly, it completely fits the macro trend we are seeing. February deal values just hit $550 billion globally.
Almost double from January. It is the second highest monthly total in 4 years.
Exactly. The market is roaring back. Sponsors are tired of sitting on dry powder, so they are taking big structural swings.
Speaking of massive structural swings, ocean freight is apparently sexy again because Hapag-Lloyd is writing a $4.2 billion check to swallow Zim and rip it right off the New York Stock Exchange. Voices, $550 billion in 1 month. I read that analyst note this morning and actually had to clean coffee off my monitor.
February was wild. Deal values nearly doubled, and it's the second highest monthly total we've seen in 4 years.
So the sell side is finally earning its keep again. The consensus out there is that global M&A is officially roaring back.
Roaring back is a very generous narrative. Look at what's actually driving that deal count. The strategists are all pointing to software.
Because of the AI arms race, which is a totally valid catalyst. Every legacy firm out there is terrified of missing the boat.
It's a valid catalyst, but it means the recovery is heavily concentrated. It's not some broad, healthy market resurgence. Plus, look at the risk reports. They just swapped out the boogeyman.
You mean inflation?
Right. Last year, every board blamed inflation for sitting on their hands. Now the experts are saying regulatory changes and global trade tariffs are officially the top risks.
Wait, tariffs? Are we time traveling back to 2018?
Exactly. It's just the new all-purpose excuse for why a deal might stall. Management teams always need a macroeconomic scapegoat for the footnotes.
Oh, come on. The regulatory fear is totally justified right now. You can't just brush off the current antitrust environment. If I'm advising a board today, I'm absolutely putting regulators and tariffs on page 1 of the pitch deck.
I'm not saying the risk is fake, Nate. I'm saying they use it as a convenient parachute when they realize they're about to overpay for some AI startup.
Well, overpaying is an art form. Speaking of which, wait until we look at the massive premium Apollo is throwing at a Japanese glass company. Spill the tea. I'm telling you, private equity in sports is the absolute Wild West right now. Blackstone looking at a stake in a new global cricket league? I love it. Put me in, coach.
You don't even know the rules of cricket.
I know the rules of a captive audience of 2 billion fans, Maya. You don't need to understand a wicket to understand those cash flows. It's uncorrelated yield.
Uncorrelated until a massive scandal hits the league. I'll wait for the actual term sheet. But speaking of captive audiences, can we talk about Puig and Estee Lauder? Because Puig stock absolutely flew today.
Pure corporate theater. Estee Lauder officially confirmed they're in merger talks. They never do that. Usually you get the standard, we don't comment on market rumors boilerplate.
Exactly. Somebody leaked it, and somebody else wanted that stock to pop to force a higher premium.
It's a brilliant play for Estee Lauder. They need Puig. They need that prestige fragrance portfolio.
Oh, come on. Brilliant? It smells like absolute panic to me. Estee Lauder is bleeding market share to indie brands, and their core demographic is aging out. They're just trying to buy relevance.
Buying relevance is literally the entire history of the beauty industry. You acquire the cool kid on the block before they eat your lunch.
I just want to see the multiples they're paying for that cool kid. If they pay a massive premium just because they're desperate, that's not brilliant strategy. That's a rescue mission.
Fine, let them have their very expensive romance. Meanwhile, Gilead is being incredibly quiet about dropping $2 billion on Uro medicines.
Classic pharma playbook. Keep it out of the press until the ink is completely dry. No press releases, no confirmed talks. Just quiet diligence.
Exactly, a nice contrast to the beauty industry drama.
Well, the ink might be drying as we speak. We're watching for the formal announcement on that Gilead deal tomorrow, along with some massive regulatory filings on the tech side, which brings us to exactly what we are tracking for the rest of the week. Tomorrow's radar.
I am telling you, watch the ticker tomorrow for Gilead. The whisper number on Uro Medicines is 2 billion, and my guess is we get the formal announcement before the bell.
2 billion for Uro feels steep. I need to see the milestone payouts in the fine print before I buy that narrative. Honestly, I am way more focused on the AES Corp regulatory filings dropping tomorrow.
Right, the GIP and EQT mega deal. $33.4 billion of pure infrastructure.
Exactly. With global trade tariffs officially replacing inflation as the top deal risk, I want to read exactly how they are wording the risk disclosures.
You and your footnotes. If you want pure entertainment value tomorrow, keep an eye on Blackstone. Word is they are evaluating a stake in a new global cricket league.
Wait, really? Blackstone is doing cricket now?
Private equity finds a way, Maya. First they buy your uniform rentals, then they buy your sports.
Well, February deal values just hit 550 billion, so I guess they have the cash to buy whatever they want. We will see what actually clears the regulatory hurdles tomorrow.